Welcome shareholders to Genesis XY Shoe Company's annual report. I am your CEO, Natasha Wool. Genesis XY was founded in a garage, becoming a small startup located in San Antonio, Texas, and has grown incredibly ever since. Our strategy is cost leadership. Since our humble beginnings, we recorded $233 million in revenues by year 1, and by year 17 increased to $439 million, nearly doubling. We have added 2 plant upgrades to increase our operating capacity. We have increased our cash on hand. We have reduced our debt, and we have increased our operating profit to 23.8%. While our continued growth may not be as dramatic over the next 8 years, it is expected to be both substantial and sustainable. We are currently second in the industry. We began in last place. Our future looks bright. We can expect continued growth in revenues, market share, and profits for our shareholders and investors. We will continue to be an industry leader in cost leadership and quality footwear. Finally, we thank you, our shareholders, and our investors for your continued confidence and support. Next, we are highlighting the last 3 years of our income statement figures, which is brought to you by the Chief Operating Officer, Cesar Gutierrez.
Good evening, shareholders. My name is Cesar Gutierrez. I am your current COO, Chief Operating Officer. I will be going through the report of the last 3 years. I will be starting off with our plant capacity. Plant capacity is one of the fundamental parts of our business that makes it successful. When we took this company in year 11, we had a maximum capacity of 7.2 million shoes per year. We currently have and had 2 plants, one located in North America and the other located in Asia Pacific. By year 13, we made a change to our plants because we saw and determined that they were run inefficiently to continue our cost leader vision. We started with our North America plant, and we decided to upgrade the plant, to upgrade C&D to be run more efficiently with more cost savings. For our Asia Pacific plant, we also saw that it was running inefficient, and we decided to upgrade to B and C to make it run more efficiently. Through these upgrades, we were able to save so much and continue our cost leader vision, and for the past 3 years we have averaged a $9.5 million in savings for our 2 plants. After the upgrades, we also decided to increase our capacity. We increased our capacity to 700,000, giving us a total of 8.5 million maximum capacity. We made this decision. This was a very tough decision for us to make, but we decided to make this increase of capacity due to the fact that there was an opening to enter the private label market. We saw minimal competition, and we saw an opportunity to take advantage of it, and we did. That pretty much runs our plant capacity and our manufacturing in Asia and in North America. I will be moving on to our revenues. When we took this company, also on our revenues in year 11, there was 233 million revenues. By year 17, we had a maximum of 439 million. We feel that that was a big increase in our company from when we took it. But in order for us to make this increase in revenues, we had to make other changes to our operating procedures. One of the things that we saw that we were having too high expenses. Our expenses were too high, and we decided to take action on these expenses. So we were able to lower our expenses for the past 3 years. We started with warehouse expenses, and we focused to lower our warehouse expenses. We started with 6.8% on year 16, and by year 18 we had 6%. That was almost 1% total decrease in expenses just for warehouse expenses. For our marketing expenses, we started in year 16 of 18.8%. Year 17, we lowered our marketing expenses to 16.7%, but we saw that as a fundamental error because our sales did not increase. and actually decrease by decreasing our marketing. So we decided to increase our marketing once again to 17.5, still below the 18.8 we started on year 16. For our administration expenses, we started in year 16 to 2.5, and we were able to maintain through 3 years the 2.5% of administration expenses. I will be moving to our cost of shoes. Our cost of shoes, we were one of our industry leaders in cost per shoe. We had a percentage of 49% on cost of shoes in year 16 to 49%. By year 18, we had the cost of shoes was 50.1. There was a slight increase on our cost per shoes, and that's due to the fact that the market demanded more higher quality, higher star shoes, and we were needing to move to a 10-star, which is the reason why our cost of shoes increased just slight. But at the same time, we continue to be an industry leader in percentage of cost of shoes. We'll be moving on with our profit margins. Profit margins was one of the main things that we wanted to focus on. We wanted to have profit of everything we do in this company. We wanted to have as higher profits as we could. And as we thought of it, we did. Our profit margins in year 16 was 15.4, and by year 18, we increased them to 16.8, all at the same time by decreasing expenses and our percentage of cost of shoes, which we believe are very good decisions, and it shows that the company is moving forward in the right direction. I will be talking about our internet and wholesale markets. Our internet market was one of our strongest ones for the past 3 years. We actually had the highest market share on internet segment from year 16 and 17. For our wholesale segment, we were able to maintain our market share, even though we were increasing our shoes because the market was demanding higher quality shoes. We were increasing our shoes, so in order to increase the quality of our shoes, we had to increase the price of our shoes. And even though we had to increase the price of our shoes, we were able to maintain our market share in the wholesale department. And from year 16 to year 18, we also, as I mentioned previously, we entered the private market with great success, and we had great market share for our private label for those 3 years. And we believe that the private market label was a major part, a major contribution for our company, Genesis XY, to become an industry leader and be second place in the leaderboards. Thank you. And I will be introducing our CFO, Chief Financial Officer, Antonio Gonzalez.
Good evening, shareholders. My name is Antonio Gonzalez, and I'm your current CFO, Chief Financial Officer. Tonight, I'm going to be talking about the results for the past 3 fiscal years, starting off with cash on hand. In year 16, we had $58,257,000 worth of cash on hand. We steadily increased that throughout year 18 to $105,365,000 of cash on hand. And we owe this greatly to the cost of our shoes, to their low cost, as well to other effective decisions that we made within the organization in order to lower our cost. Next, I'm going to be talking about our assets. In year 16, we had assets of $420,977,000. We steadily sustained that throughout year 18 from $420,239,000. This is due largely because of the dividends that we had paid out, as well as no other upgrades that were made throughout these 3 years. We had our upgrade in year 13, and we maxed them out in year 14 as well. As a company, we like to gauge our growth and our performance by ratios. And one of the most valuable ratios that we had to us, that we utilized and we made our decisions based upon, was our internet operating profit margin. In year 16, we were able to generate 30.5% of operating profit margin within the internet. We sustained that to year 18 to 32.9%. This is hugely this is one of our greatest advantages because of our low-cost shoes. As well, it gives us more flexibility with pricing options in order to be more competitive with all the other companies out there in the industry. Internet market operating profit margin was the highest for us out of the two markets. Wholesale in year 16 was 21.1%. Year 17 we had 21.5%, and year 18 we had 22.3%. That is an average of 21.1%, and it is well above the industry averages. I'm going to move on next to our liabilities. In year 16, we had $38,413,000 worth of liabilities. And with the great management that we have in place and the effective decisions that we made, we were able to pay down that debt nearly to half its value, which is $17,585,000. And this is due largely to our priority to not have as much debt as a company and be able to have more cash in order to purchase more capacity or in order to upgrade our plant even more and our materials, as well as our Six Sigma and our best practices. And this year, to you shareholders, we paid out a dividend of $5.50. That is the largest dividend that we have paid out in our company. It is a history. It's a record. It's a record for our company in order to pay that out for you. And that is just to show our gratitude to you, the shareholders, for investing in us, and trusting us as a company with your money and your life savings. To conclude, I would just like to say that Genesis XY, we started at humble beginnings and a simple idea. We have grown and progressed and prospered. Without our shareholders and our investors, the opportunity to succeed would not have been possible. We thank you, shareholders and investors, for your confidence and your support. We will continue to offer the highest quality product and our vision and standing as industry leader. Leverage our prices, and we want to preserve our competitive advantage as well. While it may not be possible to double our revenues within the next 8 years, we are confident your return on equity and stock prices will continue to rise and be continued. Again, we thank you for your patronage and your trust. Thank you. Have a good night.